But since the war has started, Bitcoin has outperformed. It's outperformed NASDAQ and Magenta and outperformed the SaaS stocks. And basically, I think that Bitcoin is now focusing on wartime inflation. What is going to change now that there is an explicit admission by the United States and a lot of other countries that they're on a wartime footing, their defense spending is inadequate, and they need to print more money to build more bombs? So that is, putting the AI to the side, moving on to the Fed. And so, when Kevin Warsh was nominated, I think it was in January of this year, everybody started freaking out because in his tenure from when he was a governor, I think during the financial crisis after 2008 until present, he's been very critical about the Fed's very large balance sheet. And he's gone on record saying that he believes that the Fed balance sheet is too large, that he's got to find a way to shrink it, and alongside that, he'll be able to lower interest rates. Now, if you read my essays, you know that I am a big proponent that the quantity of money is more important than its price. And so I care more about what he says about the balance sheet than where the short-term interest rates go. And so if the market believes that there's going to be less dollar liquidity floating around the system because of what Warsh will do at the Fed, then they'll be bearish on Bitcoin and other risk assets. This is what we've seen in sort of the media talking about sort of this hawkish Fed that's going to come into place after May when Warsh takes over. Now, I don't believe that's the case. I believe that essentially the Fed will swap reserves and treasuries and repos and put them on the commercial banking system. And they'll do that with the help of new regulations in terms of how banks are allowed to hold assets on their balance sheet and how much capital they have to have against those. And finally, what I think is the most important to understand what Warsh will or won't do at the Fed is that he has a very material binding constraint. And that is he needs to work alongside Scott Bessent at the Treasury to make sure that whatever he does with the Fed's balance sheet does not impair the ability for Bessent to go out and sell billions of dollars of bonds. So here is a very simple balance sheet. There's no numbers because I know that's a little bit complicated for some people. So on the asset side, treasuries, mortgage-backed securities, and repos. So these are the things that help people finance the purchase of treasuries. On the liability side, there's bank reserves, the Treasury General Account, the checking account of the government, and currency in circulation. And essentially, from 2008 to the present, the Fed boosted its liabilities in the terms of bank reserves and bought assets from the banking system. That's treasuries, mortgage-backed securities, and repos. And when Warsh says that the balance sheet is too large, he's saying that the Fed owns too many of these debt securities, and he wants to be able to reduce that balance sheet. So again, he could sell bonds. That's very disruptive to the market. Or what I think and what has been hinted at is that he'll do a swap with the US banking system. Now, the bank balance sheet, commercial banking balance sheet, again, has Fed reserves as an asset, something like $3-ish trillion that they have on balance with the Fed. They have loans. On the funding side, deposits, and shareholders' equity. And so for a certain size of balance sheet, you have to have a certain amount of equity against it, and that's sort of capital adequacy ratios. And so what needs to happen is that the Fed and the banks need to swap. The banks need to get rid of the reserves, have a lesser demand for reserves, and replace those reserves with treasuries and repos. And this is what is being pushed with the deregulation of the US commercial banking system. So whenever you think about or hear Bessent and any other monetary officials of the United States government talk about deregulation, what they mean is we want to allow the banking system to absorb all of this debt that we're creating and take it off of the balance sheet of the Fed. And again, the end state is that the US commercial banks take over the money creation baton from the Fed, and you have treasuries and repos on their balance sheet, and the liability side deposits shareholders' equities. Now, the point of all this is that the net effect to dollar liquidity is neutral. There's nothing being sold, there's nothing being bought. It's just a swap. It's purely regulatory fiction in terms of who is allowed to hold what. But at the end of the day, Warsh can get up and tell people that he has engineered a smaller Fed balance sheet. But in reality, for us as investors, all we care about is what is the net effect. The net effect is nothing. And furthermore, Warsh is not going to get into a fight with Bessent. They had this photo with Jerome Powell's face before. We'll just replace it with Warsh. At the end of the day, when you've issued $38 trillion of debt and you need to fund the government the Federal Reserve will do what it's asked to do, which is make sure that the market is orderly so that people can buy this debt. And looking at spending. So this is a chart of the fiscal year. It's October to September. And as we can see, deficits from the COVID period to the present, largest peacetime deficits in the United States history, and fiscal year 2026, slightly tracking as a larger deficit than 2025. Now, the point of all of this is that the US Treasury is not going to spend less money. Donald Trump is not talking about how he's going to reduce spending in a dramatic fashion. That Doge thing happened last year. It's all forgotten about. It's all about wartime spending. His new defense budget is something like 50% over the previous one at $1.5 trillion. That does not sound like a Treasury or politicians who are coming together to reduce spending so that the Fed can reduce its balance sheet. So all this talk about the Fed shrinking its balance sheet makes no sense because the politicians and the Treasury that funds them is continually increasing the amount of debt that's out there. Here's another graphic. Who is buying the debt? The foreigners are not buying as much debt as they used to. I excluded countries that are usually used for hedge fund balances for the basis trade. And what you can see here is that 25% ownership of foreigners has sort of flatlined while the amount of debt has gone up a lot, which basically means there needs to be a new price-insensitive buyer for all that debt, and that is the US commercial banking system. Now, the banking system can increase the amount of debt because of new regulations that just went live on April 1st of this year called the Enhanced Supplemental Leverage Ratio, and basically allows banks to hold less reserves and other types of assets against the loans and other things it has on its balance sheet. And this means that large banks like JP Morgan and Citibank can onboard more treasury and repos in the market and take that rollover from the Fed. And for smaller banks, the engine of lending within the United States economy, they can increase the amount of construction and industrial loans that are out there. And S&P Global estimates that this ESLR balance sheet reduction will generate $1.3 trillion of new loans. Now, why will banks have demand for loans? One of the criticisms about this analysis from some of my other macro friends is that they claim the banking system is not creating enough loans, so there's not enough demand. Well, we have a great source of demand, that is the US Department of War. They not only will put in equity into certain deals, they'll guarantee offtake production, and banks, seeing that companies have a guaranteed customer that is a government that can print money, they will lend to them. They'll also lend to the resource miners who are mining the critical resources that go into making bombs. And finally, all of the AI capex is now a national security concern. And so when a hyperscaler runs up against the ability not to finance their debt out of free cash flow and they go to the market, they will find willing large banks with a massive balance sheet to support that debt. So monitor construction industrial loans. You can get it, I think, on a weekly basis from the Fed. This is just a chart from Bloomberg. The credit must flow. The great thing about bank lending is that it has a higher multiplier than central bank lending, at about 3 empirically, we've seen empirically. So that's about $4 trillion that's created, which means that it's larger than the amount of credit that could be destroyed by AI taking people's jobs, which is why I've turned more bullish on Bitcoin. And I've got a few seconds left. Again, my liquidity chart has bottomed back in November of last year, around the same time that Bitcoin did. I think we've had a bit of a chop, we've had a bit of a war. Now it's time to break out, and that's why I believe Bitcoin is going higher. I think my end of year price target is like 125,000. Whatever, it doesn't fucking matter, I'm long anyways, but thank you very much, everyone.